Day trading looks simple from the outside. You see screenshots of huge profits, you see traders posting winning trades on social media, you hear stories about someone turning a small account into a fortune. But what most people never see is the emotional storm happening behind the screen. The truth is that day trading isn't just a financial game, it's a psychological battlefield. Every click of the buy or sell button triggers emotions that most people are not prepared to handle. Excitement, fear, greed, doubt, hope, frustration, and sometimes pure panic. Many new traders believe the market is their biggest opponent, but in reality, the biggest opponent is sitting right in front of the screen. It's their own mind. Today, we're going to talk about the emotional roller coaster of day trading, why it happens, why it destroys so many traders, and how the few traders who survive learn to control it. Because if you don't control your emotions in the market, they will control you. The beginning, excitement and possibility. Every trader begins the journey with excitement. There's something incredibly appealing about day trading. The idea that you can sit in front of a computer, analyze the market, place a trade, and potentially make money within minutes. For many people, it feels like discovering a hidden world. Charts become fascinating, candlesticks feel like secret messages, indicators look like tools that might unlock unlimited profits. At the beginning, everything feels full of possibility. You watch YouTube videos about trading strategies, you see traders explaining patterns that look incredibly simple. Support and resistance, breakouts, trend lines, moving averages. It all seems logical. You start believing that if you just learn the right strategy, you'll start winning. And then you place your first trade. Your heart beats faster. The market moves a little bit in your favor. Your account balance increases. Even if it's just a small profit, it feels incredible. In that moment, you think you found the answer. You imagine what will happen when you scale up. If you made $10 today, maybe next month you'll make $100, maybe $1,000, maybe even more. At this stage, the emotional roller coaster hasn't started yet. Right now, it feels like the beginning of something amazing. But the market has a way of testing that excitement, and the test usually comes sooner than expected. The first loss. The first loss hits harder than most new traders expect. At first, it doesn't seem like a big deal. Every trader says losses are normal. Every trading book repeats the same message. Losses are part of the game. So when your first trade goes against you, you try to stay calm. You close the trade. Maybe you lose $20, maybe $50. You tell yourself it's just a small setback. But something interesting happens in your mind. Your brain doesn't like losing money. Even small losses create discomfort. Psychologists have studied this phenomenon for years. Humans feel the pain of loss far more intensely than the pleasure of gain. So even though the loss might be small, your brain remembers it. And when the next trade comes, something changes. Now there's hesitation. Now there's doubt. You start thinking about what might go wrong. And that's when the emotional roller coaster begins. The first big win. Then something exciting happens. You catch a big trade. Maybe the market breaks out exactly like you predicted. Maybe the trend runs perfectly. Your profits start growing quickly. Your account balance jumps. This moment feels amazing. Your confidence skyrockets. You start thinking things like, maybe I'm actually good at this. Maybe trading really is the opportunity everyone talks about. The dopamine rush is powerful. Winning trades trigger the same reward systems in the brain that gambling does, and that feeling can become addictive. The danger is that big wins often create unrealistic expectations. You start believing that every day could be like this. You start believing that consistent profits are just around the corner, but the market has another lesson waiting for you. The first losing streak. Sooner or later, every trader experiences a losing streak. 3 losses in a row, 5 losses in a row, sometimes even more. This is where the emotional roller coaster becomes intense. After several losses, frustration starts building. You begin questioning everything: your strategy, your analysis, your ability. You look at the charts and think, how did I miss that? Why did the market reverse right after I entered? At this stage, emotions begin to influence decisions, and that's when dangerous habits appear. Revenge trading. One of the most common emotional reactions in trading is revenge trading. You take a loss. Instead of accepting it calmly, your mind starts thinking about getting the money back immediately. You enter another trade, but this time the decision isn't based on your strategy, it's based on emotion. You want the market to give you back what it took. You increase your position size. You take trades that don't fully match your rules. You act quickly, sometimes impulsively, and more often than not, that emotional decision leads to another loss, which makes you even more frustrated, and the cycle continues. This is one of the fastest ways traders destroy their accounts, because trading while emotional is like driving while blindfolded. You're making decisions without clarity. Fear after losses. After enough losses, another emotion takes control: fear. Now every trade feels dangerous. Even when you see a good setup, hesitation appears. You think, what if this one loses too? So you hesitate. Sometimes you skip the trade, and then something painful happens. The trade works perfectly without you. The market moves exactly how you expect it, but you weren't in it. That moment creates a new emotional problem: regret. And regret often leads right back to impulsive decisions. The FOMO trap. FOMO stands for fear of missing out. It's one of the most powerful emotions in trading. After watching the market move without you, the pressure starts building. You don't want to miss the next opportunity. So when you see the price moving quickly, you jump in. Even if the move is already halfway finished, even if the setup isn't perfect, you enter the trade late, and very often that's exactly when the market reverses. This creates another loss and another emotional swing. Excitement turns into frustration, hope turns into anger, confidence turns into doubt. This is the emotional roller coaster most day traders experience, and it can be exhausting, not just financially, but mentally. Overtrading, the hidden trap. After experiencing wins and losses, many traders fall into a dangerous habit: overtrade. Overtrading happens when a trader starts taking too many trades in a short period of time. Sometimes it happens after a loss. The trader wants to recover the money quickly. Other times it happens after a big win. The trader feels confident and believes they can keep winning, but the result is usually the same. The trader begins forcing trades that don't actually meet their strategy. Instead of waiting patiently for the right setup, they start clicking the buy and sell buttons constantly. The market becomes a source of entertainment instead of a place for calculated decisions. Every small movement in price looks like an opportunity. Every tiny candle feels like a signal, and the trader slowly loses control. Professional traders understand something that beginners often ignore. The best trade is often no trade at all. But when emotions take over, sitting and doing nothing feels impossible. Your brain wants action, your brain wants excitement, and the market is always ready to provide it. The stress of watching every tick. Another part of the emotional roller coaster comes from staring at the charts. Day traders often watch every tiny movement in price. Every second feels important. Every tick up or down triggers a reaction. When the trade moves slightly in profit, hope appears. You start imagining how big the win could become. But when the price pulls back just a little bit, anxiety appears. You begin worrying that the trade might reverse completely, so you watch the chart more intensely. Your heart rate increases, your mind starts running through different scenarios. Should I close the trade now? Should I give it more time? What if it drops further? This constant tension can be exhausting. The brain was never designed to process financial risk every second of the day, and when traders expose themselves to this level of stress for hours, their decision-making ability slowly weakens, fatigue sets in, clarity disappears, and mistakes become more likely. The addiction of trading. One reason day trading is so emotionally intense is because it activates powerful reward systems in the brain. When a trade wins, the brain releases dopamine. Dopamine is a chemical associated with pleasure and reward. It's the same chemical involved in activities like gambling, gaming, and social media. That rush of excitement can feel incredible. The problem is that the brain begins chasing that feeling. Traders start looking for the next dopamine hit, another trade, another win, another rush of excitement. This is why some traders struggle to stop trading even after a profitable day. Instead of protecting their gains, they continue trading. They tell themselves they're just looking for one more setup, but often that extra trade leads to unnecessary risk, and sometimes it turns a profitable day into a losing one. This cycle can quietly turn trading into something very similar to gambling, and that's a dangerous place to be, because gambling is driven by emotion. Trading, on the other hand, requires discipline. The confidence trap. Winning can actually be more dangerous than losing. When traders experience several successful trades in a row, confidence grows quickly. Confidence is important, but too much confidence can lead to overconfidence, and overconfidence creates blind spots. A trader who feels unstoppable might start increasing position sizes. They might stop following their rules strictly. They might believe they've finally mastered the market. But the market has a way of humbling everyone. Even the best traders in the world experience losses. No strategy works 100% of the time. And when an overconfident trader finally faces a losing trade, the emotional impact can be severe, because the loss doesn't just affect their account balance, it damages their confidence. Suddenly, they begin questioning themselves again. The emotional swing from confidence to doubt can be intense. The psychological breaking point. For many traders, there comes a moment where the emotional pressure becomes overwhelming. This moment often arrives after a series of losses or a particularly painful mistake. Maybe the trader ignored their stop-loss. Maybe they risked too much on one trade. Maybe they tried to revenge trade and ended up losing even more. The account balance drops sharply, frustration builds, and the trader begins asking difficult questions. Am I really capable of doing this? Maybe trading isn't for me. Maybe the market is impossible to beat. This psychological breaking point is where many traders quit, not because they lack intelligence, not because they didn't study strategies, but because the emotional pressure becomes too heavy. Trading exposes people to uncertainty, risk, and self-doubt every single day, and without strong psychological control, those pressures can slowly wear a trader down. Some traders walk away at this stage. Others continue, but repeat the same emotional mistakes again and again. But a small group of traders does something different. They begin focusing less on the market and more on their own mind. The turning point. At some point, every serious trader faces a decision. They can continue reacting emotionally to every win and loss, or they can begin treating trading like a professional skill. This is the turning point. The moment where traders realize that success in the market has far less to do with predicting price and far more to do with controlling themselves. Professional traders understand something that beginners often overlook. The goal of trading is not to win every trade. The goal is to execute a process. That process includes clear rules. Rules about when to enter, rules about when to exit, rules about how much risk to take, and most importantly, rules about when not to trade, because the real power in trading comes from discipline, not excitement. The power of accepting losses. One of the biggest psychological shifts a trader can make is learning to accept losses. This sounds simple, but in practice, it's extremely difficult. Most people enter trading with the belief that losing is failure, so when a trade loses, they feel like they made a mistake. But professional traders view losses differently. They see them as a cost of doing business. Just like a restaurant owner expects to pay rent and utilities, a trader expects some trades to lose. Losses are not the enemy. Uncontrolled losses are the enemy. A small, planned loss is simply part of the strategy. Once traders truly accept this idea, something powerful happens. The emotional intensity of trading begins to decrease. Instead of fearing losses, they simply manage them. And that mindset changes everything. The importance of risk management. Another major difference between emotional traders and professional traders is how they manage risk. Beginners often focus on how much money they can make. Professionals focus on how much money they could lose. This might sound pessimistic, but it's actually the foundation of long-term survival in the market. Professional traders carefully control position sizes. They risk only a small percentage of their account on each trade. They place stop losses before entering a trade, and they accept that protecting capital is more important than chasing profits. Because if you protect your capital, you always have another opportunity. But if you lose your entire account, the game is over. This mindset turns trading from an emotional gamble into a structured business. The discipline of patience. One of the hardest psychological skills in trading is patience. The market is open for hours, charts are constantly moving, opportunities appear to be everywhere, but the reality is that high-quality trading setups are rare. Sometimes the best decision a trader can make all day is doing absolutely nothing. This is extremely difficult for beginners. Doing nothing feels unproductive, it feels like missing opportunities. But professional traders understand something important. Every trade carries risk, and unnecessary trades carry unnecessary risk. So they wait, they observe, they let the market come to them. And when the right setup finally appears, they act with confidence. Patience isn't just a personality trait in trading, it's a competitive advantage. The calm mind of a professional trader. When you watch experienced traders, something surprising stands out. They don't appear overly excited when they win, and they don't appear devastated when they lose. Their emotional reactions are controlled. This doesn't mean they don't feel emotions. It means they don't allow emotions to control their decisions. They understand that trading is a long-term game. One trade doesn't define their success. One day doesn't determine their future. They focus on executing their strategy consistently, trade after trade, day after day, month after month. This calm mindset removes much of the emotional chaos that destroys beginner traders, because when emotions are stable, decisions become clearer. The real secret of successful traders. Many new traders spend years searching for the perfect strategy, the perfect indicator, the perfect entry signal. But the truth is that the biggest edge in trading isn't found on a chart, it's found in psychology. The ability to stay disciplined after losses, the ability to stay humble after wins, the ability to follow a plan even when emotions are screaming for you to do something else. This mental strength separates the small percentage of profitable traders from the majority who struggle. The market will always move unpredictably, but your reactions to the market can be controlled, and that control is where real progress begins. Final thoughts. Day trading will always be an emotional experience. There will always be moments of excitement, moments of fear, moments of doubt, moments of frustration. The emotional roller coaster never completely disappears, but experienced traders learn how to ride it without losing control. They stop chasing every movement in the market. They stop reacting impulsively to every win or loss. Instead, they develop patience, discipline, and emotional stability. Because in the end, trading is not just a battle against the market, it's a battle against your own psychology. And the traders who win that internal battle are the ones who give themselves a real chance to succeed.